the C-Suite Edge podcast. I'm your host, John Light. I'm also the president, CEO, and founder of Sabertooth Recruiting. And today we're going to have a chance to dive into something that's relevant to everybody, both on a, I would say, can I say a personal residential and professional commercial side in the mortgage business and lending business. And so I have today with me from Home Loans, Inc., Jason Sharon. Jason, thanks so much for joining me today.
Thanks for having me, John. I'm honored to be here.
So I want to have some fun with this, but I think we need to kind of lay the groundwork first. So can you share a quick rundown, a minute and a half or two or whatever, kind of describing your career path, what got you into this space, if you will, and tell us a little bit about Home Loans, Inc. as well.
Absolutely. So Home Loans, Inc. is a small family-owned mortgage brokerage. We're out of Charleston, South Carolina, licensed in 7 states, so all the Southeast, West Virginia down to Florida, over to Alabama. And we specialize in getting people, we specialize in turning people into homeowners, right? So I've owned this company for 7 years. Before that, I worked for someone else for 3 years doing mortgages, and that's the requirement here in South Carolina, is you must be licensed 3 years and work somewhere else before you own your own company. Before that, I was in the military for 20 years. I was a nuclear engineer. So I took whenever I started Home Loans Inc., I took the precision of running a military nuclear reactor and took that concept of running a mortgage company and making it as streamlined and as checklist-oriented as possible with military precision.
Man, that's a great concept. I wish more people did that, because I've been through mortgage processes where it was slapdash, haphazard, whatever you want to call it. Although, I'm still wrapping my mind around, let's see, nuclear engineer, okay, 20 years, mortgage broker. In a sense, it's kind of like those are very different. At one hand, you're responsible for making sure aircraft carriers or submarines or whatever it might be are functional and safe and optimized. On the other hand, you're bringing that experience almost with a magnifying glass, I suppose, in terms of the focus to individuals buying something as personal and as intimate as a home. And you and I know, Jason, that when you ask somebody to open up the curtain and let you look under the hood of the car, however you want to put it, at their finances and their financial decisions, that's about as intimate as you get when it comes to decision process with an individual or a family.
It's very accurate. Actually, in my standard operating procedures, I have a paragraph that my employees have to understand called special trust, right? Trust is trust.
Right.
Special trust is that next level that a consumer gives us, a client gives us, that they don't even realize they're giving us the amount of trust that they do. Like I know how much they're going to the liquor store. I know where they buy their underwear. I know everything. I know how many times they go to the movies. I know where they buy groceries. I know everything about them. I know if they have an OnlyFans account. I know if they're gambling. I know everything by looking at their bank statements. It's an intimate level of trust that they give us. They don't even realize it. And I try to capture that in my company procedures so that my employees understand and don't take that trust for granted.
No, it never should be taken for granted. But speaking of trust, people trust you to solve problems. And I'm curious to find out, what's the biggest problem you solve for your clients?
Mortgages are extremely regulated, just like nuclear. So, just like nuclear, energy is extremely regulated. So there wasn't much of a transition going from one industry to the other because I was used to the regulation and I could capture and understand how the regulation affects the experience. Mm-hmm. If a loan officer is haphazard and doesn't understand the amount of regulation and why the requirements are designed as they are, then yes, they will not ask for all the proper documents up front. They won't review the documents with the right concept and the right eye towards that. And therefore, how I look at it is, because of my regulatory background, I can look at and create and structure the file right at the beginning. Mm-hmm. Clients are very compliant in the very beginning of a mortgage process, right? They're excited about the house. They're excited to get going. They're excited to get this done. They will give you anything. They're like little bitty Labrador puppies that are happy, wagging their tail, tongues out. You need this, you need that. Got it. I will get this to you. They'll be sending me documents at midnight, happy as can be to give us everything. At about day 14, about day 15 in the process, they turn into the devil. They don't want to give you anything else
They turn into the
at
angry
day
lab.
15. Yes, they go from the nice lab puppy to the mean cat that's grumpy and 18 years old. They don't want to do anything at all. So what I do is I front load and explain to the client, hey, this is what we need, this is why we need it, because people will generally give you something if they understand the basis, the why, and you have to have that level, that graduate level of knowledge on the requirements in order to explain the why behind something, and you've got to do that in the beginning, because if you wait till the end, they're going to be all kinds of mad at you.
Yeah, interesting. So, talking about clients, and you talk about trust, and you talk about customer service, and it's really a sales job that you're applying your systems to, and your focus on process and optimization. And when you talk about sales, there's a psychological component. There's I've heard it described as there's an art and there's a science, right? And there's a science of getting things moving along, and you can control that to a degree, like you do on the front end. If we're going to get a VA loan or an FHA or conventional, or we got to do a jumbo or whatever, there's a process, you know what to expect because it's known, it's done over and over and over again. But the art, man, that's really managing those clients, because I tell people all the time when I prep them for interviews. It was Maya Angelou who said something, I'm paraphrasing here, to the effect of, I may not remember what you did or said, but I remember how you made me feel.
For sure.
And it's always important in a process like this that people feel secure in the trust and in the process. And at the end, they're confident and content. They're satisfied with what's been delivered. And there's always that small percentage you can't make happy no matter what you do.
Right.
But I think how you put them through the process, how you go about it, is huge. I think that's a cultural thing, how we get stuff done. And if you make it less painful, less aggravating, less annoying, because to your point, you're on the front end when things are fresh and exciting and vibrant, I'd say kudos to you, because a good experience getting a mortgage is every bit as important as moving into the house, because you're stuck with that house, but you're also stuck with that payment and the terms. And the two go hand in hand. Let me ask you this, out of curiosity, and I mean strictly curiosity, I'm not asking you to tell me who's going to win the Super Bowl here or what the lottery numbers are. Well, maybe what the lottery numbers are. But when we look at what's going on in the interest rate space, a lot of people don't understand the processes and mechanisms that drive, say, a 30-year rate or a 15 or 20 or anywhere in between. Because it's not directly tied to what the Federal Reserve does. It's not directly tied to 10-year bonds, although it seems to have some correlation. It's not tied to a lot of stuff. I'm curious as to what your comments or insights would be on what drives it up or down, and maybe a mild prognostication. What do you think it's going to do in Q4 of 25 and maybe the first half of 26? Not to hold your feet to the fire, but I'm just curious to get what you kind of see developing out in the marketplace.
For sure. And I have this discussion every day with somebody. I mean, this is, answering this question is second nature to me. I like to joke that there's two types of people that speculate about mortgage rates: those that don't know what they're talking about, and those that don't know they don't know what they're talking about. What are interest rates? Interest rate is just the supply and demand of the U.S. dollar bill. Like, how many dollar bills are out there, and how many dollar bills do people want to borrow, right? And then for the mortgage industry, you narrow it down more of how many investors are out there wanting to buy mortgage-backed securities, and how many people want to buy houses. And taking the definition of economics, which is the study of human behavior based on monetary influence. As interest rates go up, less people want to buy houses because they're people buy houses, but really people are buying mortgage payments is what they're really buying, which is kind of what you alluded to earlier. Now, what drives mortgage rates? I try to educate people that the leading indicator for what mortgage rates are going to do is the 10-year Treasury bill, right? So mortgage rates are generally going to be modeled after the 10-year Treasury bill plus some margin. And historically, that margin has been about 1.75% above the 10-year T-bill yield, going back 20, 30 years. During COVID, that got very, very small. The 10-year dropped and the margin got smaller. Following COVID, as the 10-year jumped up significantly, the margin actually got higher because mortgage companies were bleeding profit, so they had to build a higher profit margin in
Right.
that. So mortgage that spread has come down to about 2. We're still about 25 basis points away from the historic average. So we could see another 25 bip improvement in mortgage rates as the margins get back to where they have been historically,
Right.
and as the 10-year Treasury bill improves, or I guess I don't know if the right word is improve, as it goes down, and we're having a lot of resistance at 4.00, but as it gets below, it starts with a 3, that'll see interest rates get better. I don't think we're going to see significant improvement in mortgages until we get through all the tariff stuff, tariff on, tariff off, wax on, wax off. I joke it's the Karate Kid tariffs. Once we get through the Karate Kid tariff, wax on, wax off thing, the bond market, I think, will get a little bit more confidence in mortgages, and then we'll see some better rates.
Yeah, no, I can't disagree with anything you said in that regard, because uncertainty is the enemy of markets.
For sure.
It's like, okay, I'm going to go buy $100 worth of groceries. I have my list, I have my coupons, whatever. I go in the grocery store, and from the time I pull in the parking lot, the time I walk through the door, prices go up 20%. And now that $100 is $120, and I don't have it.
Yeah.
I mean, we're all happy when we go with 100 and we walk out with 10 because it dropped to 90. But the fact is, there's a lot of fear and uncertainty around price stabilization and what to expect.
Right.
And it's ironic about it is that in all of these negotiations, however you choose to look at them, whatever end of the political spectrum a person is on, because we have such massive trade deficits, we hold all the cards. Everybody wants into this marketplace, including people who want to purchase mortgages on the secondary market or bundle
Sure.
them up into bonds, because the credit here is great. We're consumers, but we make high incomes. I mean, from a global perspective, and so people want access to the market, and it gives us a huge advantage that we've never really capitalized on as a nation. We use it as a lever in very specific instances, but now we're going out and we're broadening that because it prevents some level of wealth exfiltration, but it also levels the playing field for American businesses, and that's on a more global sense, and it's an interesting evolution, this transition we're going through in that
Sure.
regard, but we hold the cards. And I think people need to realize when you look at a mortgage, and I don't care which kind it is, conventional, FHA, whatever, when it gets down to it, it is, to your point, very much supply and demand. And it's very much about the supply of money and what people are you willing to let that money out at. So if you're getting a mortgage, and let's just say for argument's sake it's 6%, that's because there's some investor willing to back that up and earn that return with a high probability based on your credit and background through the underwriting process, you're going to be good and pay it back. And it's a challenging thing because you can't treat a 30-year or a 15 or a 20 or whatever it is, you can't treat it the same way that you would look at something shorter term like an auto loan. Similar mechanism and process,
Sure.
but very different asset. One should appreciate, and the other always depreciates.
For sure.
And so there's always a race to the top or the bottom, I think, involved in that, and consumers need to be aware.
100% for sure. Up until COVID, and I haven't seen numbers since COVID, but the average length of time that a mortgage was held was about 7 years. That was historical. Now, what's happened with it's shifting longer now based on the people that locked in 2.5, 2.75, 3.5. So people are staying in those loans longer. But the loans that were originated in the last 24 months, which were in the 7s and the 8s, are now refined pretty quickly. The supply and demand aspect of who's buying the mortgage-backed securities, like you alluded to just a minute ago, could be foreign investors, could be, typically it's insurance companies that are buying a mortgage-backed security to even out the risk for the higher rate of return that they want in order to have enough money coming in to cover losses.
Right.
It's the New York State Teachers Association that's buying mortgage-backed securities to have some stability to their 401k investments, that kind of stuff. It's large institutional investors or maybe some hedge fund managers that are buying that type of stuff. So now the mortgage industry has to entice those investors to buy mortgage-backed securities. One is through stability, low risk, but they have to get a higher rate of return than the 10-year Treasury bill, because if mortgage pays off in 7 years, 10 years is pretty close to that. There is absolutely zero risk unless the government goes kaput in buying a 10-year Treasury bill. Right. So the mortgage rates have to be more attractive than the yield on the 10-year Treasury bill in order to attract the institutional investors to buy mortgage-backed securities. Therefore, if you see the 10-year going down, mortgage rates will go down following that. If the 10-year goes up, mortgage rates are going to go up in order to try to keep that balance, that push and pull to get institutional investors to buy the mortgage-backed securities.
You know what's crazy about it? And I know this because I was an insider in the loan officer space years and years ago. On the primary market, the secondary, and how this stuff works. Is we could go on and on talking about how this works when we get into adjustable rate mortgages, interest-only notes. I mean, there's all kinds of different things out there. But I think it would be really good if somebody wants to learn more. I mean, of course, we could keep talking about it, or they could just do something even more direct and find you on the web and reach out. So if somebody wanted to do that, connect with you, get an education, and get somebody who knows what they're talking about, what's the best way for folks to find you and get in touch, Jason?
Sure. So I make it pretty easy. Like you said, we're in sales. HomeLoansInc.com, pretty simple. I got super lucky that I was able to acquire that name.
It's a good name.
It's a tremendous asset, intellectual property asset. Obviously, all the social media things, Jason, Sharon. And then I've got the easiest phone number to remember. Area code is 843, low rate. 843 low rate is my phone number.
Awesome.
That number cost me a lot of money.
Yeah. 843 low rate. And I'll tell you something, if I want to go out and get a mortgage loan, I want to talk to someone like you who knows what they're talking about, not just, some person sitting in a bank office or on a phone bank even, who doesn't understand enough about what's backing all this up and what's driving it to be able to navigate it to get me in the best situation, because there's a lot of alignment and prioritization that needs to be done. So, Jason, thanks so much for sharing so much. And if somebody wants to get in touch, hey, I remember 843 low rate. Thanks for joining me today.
Thanks, John. I'm honored to have been here.